am Jason, Business Development Manager at the Realtomatics. Joining me is Ben Sensenbaugh, one of our owners, and our expert panelist, Kim Lochridge. So Kim, you are Executive Vice President for Engineering Tax Services?
I am, yes, thank you.
All right, would you mind just sharing a little bit about yourself with everyone?
Sure. So I've been with ETS for about 13 years, but I've been a real estate investor since the late 90s. And been working with this company since it was seed, and been able to grow the company and represent cost segregation and research and development tax credits. We do a lot of specialty tax. So.
Okay. Well, wonderful.
Services.
Well, if anybody out there listening has any questions along the way, feel free to drop them in the chat or the question and answer section here, and we'll make sure we address them. But in the meantime, if you don't mind, I'll just get started on some questions and let's see what we got here.
Okay.
So our last webinar, we did a smaller section on tax cost segregation studies, but it was not the primary focus of that webinar. So we wanted to dedicate an entire one with you. For someone who's not familiar with the tax cost segregation studies, can you explain it in a little more detail?
Yeah, so I've struggled to find a really good way to kind of explain it in layman's terms. But essentially a cost segregation study is a breakdown of the components inside of a building, an investment property, essentially. I always liken it to if you're going to file a 1040 easy, you're filing standard deductions, right, on your tax return. And if you do a 1040, you actually itemize your deductions, right? And so if you do that, you have to hire a CPA usually, and they can get you, they're worth their weight in gold, right? Because they can get you a lot more deductions, and then you can itemize those things. And that's essentially what cost seg is. Cost segregation is like the itemized deductions for a building. Instead of taking the straight line depreciation, which would be your standard deductions, you actually take the maker's methodology. You can itemize the assets on your building. The benefit to doing that is that you don't have to depreciate things like your carpeting over 39 or 27.5 years. You actually get to take it over, say, a 5-year period of time, or when it's more relevant to the class life. So that's essentially what it is. It's a breakdown of the components of the building.
Okay. So who's able to participate in a cost seg study?
Yeah, it's a great question. Really anyone can do a cost seg study on any investment property. I always get this, well, I thought it was only for big buildings that were over $1 million or things like that. But anyone who has investment property can do a cost seg study. The real question is, can you utilize the deductions from it, right? So if you do a cost seg study, how is it going to play through on your tax return? And we'll probably get into more of the passive and the active roles and how that plays through. But really important to know is that really anyone who owns investment real estate can do a cost seg study.
Okay. And are there any specific restrictions you can think of?
The only restrictions that I would think for a cost seg study, is basically, again, going back to that utilization, just utilizing the deductions. If you're a passive investor and this is a passive investment for you, then you're not going to, maybe you have lots of passive losses already. If you do a cost seg study, it has to be more strategic, right? You have to go, okay, why am I doing this? There could be a reason for banking more losses. Maybe you're going to sell a property at one point in time, and then you want to take that and offset the losses so you can just pocket the gain. But really, I don't see really any downfall to doing it other than that utilization factor. That's the biggest.
Okay. So I guess I was under the impression this was specifically for new construction within the first year, but that's not true. It can be for resale properties as well.
Yeah, you can do it on any property. So there was a bonus depreciation, which we can get into, which is totally different, but it's along the lines of cost seg. It's a result of doing a cost seg study, you get bonus depreciation. Bonus depreciation was there for new construction only up until 2017. But as far as cost segregation, you can do a cost segregation on any property that you are that you're depreciating, right? So any investment property that's on like your Schedule E, or if you have it on a depreciation schedule, you can do a cost seg study on it. We can break down those assets.
Okay. Now, does it make a lot of sense for a single unit, or is this primarily for larger portfolios?
We do single units all day long.
Okay.
So I have a big group, doctors, multiple groups that I work with that, they're investing in single family homes for vacation rentals and, just short-term, long-term rentals, short-term rentals, those types of things. We do those all day long. So a lot of investors are kind of trickling down. It's not just for the big, trophy buildings anymore, although we do a lot of those. We do a lot of large commercial properties. We do mobile home parks, car washes, gas stations, medical office buildings, commercial office space, self-storage. But we do have a big practice that deals with just, single family homes as investment properties.
And how long does it take to usually complete a study?
Great question. It takes us about 6 weeks from start to finish. We do need to have an engineer go to the site. It is required by the IRS to have a site visit. I know there's a lot of software companies out there that will have a DIY cost seg, but they're not going to go to the site. They're going to upload pictures and whatnot, but it doesn't really meet the requirements of the cost seg by the IRS. So we actually do have engineers nationwide. We got feet on the ground. We started out, so like I said, we're based in West Palm Beach, Florida. We have 16 offices, and we have a lot of remote engineers that work for us. So that's about 6 weeks from start to finish. And now's a really good time if your deadline is 4/15. We got to have signed contracts right now to be able to finish those on time for the 4/15 deadline. Otherwise, we can have you file an extension.
Okay. And what is the cost of a study, or even a ballpark approximation?
Yeah, you're going to put me on the spot here. It's going to be all over the board, obviously, because it depends on the property type and the size. We have a pricing matrix. Our pricing matrix is usually, it's based on the location of the property, the size of the property, square footage mostly, and the type of property. So say, for instance, a big apartment complex is going to be a little bit more time consuming, right, than doing something else, or medical office space is going to take us a little bit more time because you have a lot more mechanical, electrical, plumbing in a building like that. So rough, it's like maybe if it's a single family home, it might be 2,500 to 3,500, somewhere in there, depending on where it's at. If you have a apartment complex, that might be somewhere between 5 and 10,000. It just really depends, and it's kind of all over the board, but somewhere in there.
And is there any expectation of how much I can get back in taxes from doing the study?
Yeah, I have kind of a good gauge, and again, it will be based on property type, because the property type, again, like if you talk about medical office space, you do have a lot of mechanical, electrical, and plumbing, which can be put into faster class lives. So it takes a little bit more time to go through those. Those would be medical office would be somewhere like 30 to 40% of the purchase price net of land. So when we talk about purchase price, we want to say land is not depreciable. So we got to pull out land, right? So after land, net of land, I guess, you could probably get somewhere 35 to 45%. And because of bonus depreciation, that reclassification from a long-term asset to faster class life. So like when we take your carpet and take it from a long-term asset and put it into, say, a 5-year bucket, those 5 and 7 and 15-year buckets actually qualify for bonus depreciation, which means that you don't have to wait 5 or 7 or 15 years respectively to write it off. You actually get to write it off in year 1. So the bonus depreciation is a big deal. It's pretty powerful with any real estate investor. But essentially, like a single family home, you might see somewhere between 25 and 35%, maybe 25 and 40. Mobile home parks are amazing. Those are awesome. You're probably going to see somewhere between 62 and 95% write-off with those. Those are very high performance. Car washes and gas stations are usually 90 to 100%. So there's a lot of variance in what we're doing. If you had just like a warehouse, right? Warehouse storage facility with racks and stuff in it, really not much else, you're probably looking at 22% somewhere around.
Okay.
So it kind of varies.
Well, shoot, wish I had a gas station.
Gas stations are hot right now. I'm sure that you can drive around and see a bunch of them popping up because they are. I don't know about you, but in my area,
Oh, yeah.
gas stations are popping up like corks open up in my house.
Oh yeah, it's a cash cow right now.
Yeah.
So we did have a question that just popped up here. Since the Realty Max is managing a lot of new construction from the same builder with the same floor plan, if a few of us decide to do the cost seg, is there a discount? Or is there a discount for multiple parties going in at once and using your services?
Yeah, we used to do that. The problem was it was like herding cats. Because we ended up like someone would be the lead and you'd send an email and be like, hey, we're going to do a group thing. And then, we had to get all the signed contracts by a certain date, and then somebody wouldn't sign, and then it would be like, I'm sorry, we're doing all this pricing because we have all these, but then someone doesn't move forward. It created just a complete logistical nightmare for us to try and track it. So unfortunately, we can't do that anymore. But we do offer portfolio discounts. So if you have multiple properties, we can certainly offer a discount in that way because you have multiple properties. Or
okay, awesome. Well, I did have this question, and you sort of addressed it. Actually, you did address it. I just want to clarify, but this can be done for the current tax season, assuming we act now and likely have to file an extension.
Yeah, I mean, if we haven't gotten to the point where there's a proposal yet, right? Then it would probably be a good idea to file an extension, not just for you and for me, but for your CPA, because right now they're very busy right now too. So yeah, I mean, filing an extension, we can still get those done. Also, it's important to note that you can do cost segregation retroactively. You can go back to previous tax years, and the IRS doesn't require you to file an amended return. You can file what's called it's a form 3115. Apologize for the tax language, but it's a reconciliation between the old depreciation and the new depreciation. So let's say you're going to go from a cash basis to an accrual basis, and you're going to make those shift, and then there's some adjustments in there that you would have to go to. The IRS actually makes you file what's called a Form 3115. It's the same exact form. It's a change of accounting method. So you're going from that straight line depreciation to the maker's methodology. So we can do projects that have been purchased a few years ago, and we can, without having to file an amended return, those can still be done as well.
Okay, so I bought my investment property in 2020, I believe, so I can go back retroactively and still do the study.
Yeah, and they have a new rule with the bonus depreciation. So that property being bought in 2020 would qualify for bonus depreciation, but you only have 2 tax years to file it. So you would have to file it by 2022 if you want to go back and reclaim the bonus. So that's important to note, which you're kind of on a timeline there. Because what's happening now is if you file on a straight line depreciation, so you don't do cost seg, and then you learn about cost seg or something like that and hear about it and say, okay, we want to do that. But if you file straight line depreciation, you're actually opting out of your bonus. You're telling the IRS, I know about bonus depreciation, but I don't want this, so I'm going to leave it because they're assuming that everybody knows, because this has been around since 2006. So they gave us a time period, and now they're saying, okay, if you should have known about this, if you didn't know about it and you didn't take it, then you don't want it. And so you're automatically opting out of bonus depreciation. So then they give you only 2 years to get back in if you want it. So just keep that in mind, that you have kind of a time limit. It's always best to do the cost segregation and take the bonus depreciation in the year that you bought the property in that tax year. But obviously, sometimes people don't know about it and they learn about it later. So it's not all lost.
Gotcha. So is there a particular situation you could think of where maybe it's not beneficial to do the study?
Slips. if you're going to, buy something and renovate it and turn around and flip it, and sell it in the same tax year, you're not going to do, you're never really truly placing it in service. So it's not going to land on your depreciation schedule. So you obviously don't want to do a cost for that.
Yeah.
Short-term holds are very beneficial, other than flips. If it happens over the course of a couple of tax years, it could be used as like a tax deferral. So we get into more tax strategy conversations, but that is one of those things that, let's hypothetically say you buy an apartment complex and you put in, $1 million of renovations into that apartment complex and you turn around and sell it in year 3. There is still a good play for cost segregation in that stance. Yes, there will be some recapture that you would pay, and you can choose to take the bonus or not, but the cost seg benefits will help. And that's because the improvements, you can, when you do a cost seg study, there's another benefit to it other than just the immediate tax benefits. It's an ongoing benefit. It's called partial asset disposition. And what that is it's the removal of assets that are taken out of the building during renovation. Okay, so let me give you an example. If you buy this apartment complex per se, and you put on a new roof in year 2, okay, you just bought it, and then a couple of years later you have a new roof put on. Your rule is that you're depreciating the roof in the original purchase. That was part of what you bought. And then when you put the new roof on, you have to capitalize that roof by law. And so you're depreciating that over 27 and a half years. But what you can do, if you had a cost seg study done, you can go back to your cost seg study and you can write off the remaining depreciation of the first roof. Reminding you that the first roof is being depreciated over 27 and a half years. What you don't want to have happen is you don't want to have 2 roofs because that kills your recapture when you go to sell that property. You don't want to be accumulating depreciation. What you want to do is get them off the books. A, you get to take an immediate write-off, but B, you actually have that taken off the books and you're not going to be accumulating that depreciation on that asset any longer. So it's important to for like improvements and those types of things to have a cost seg study done for ongoing property.
So is that the difference between the full cost seg and the partial cost seg, or am I not understanding correctly?
The full cost seg is what we do. That's an engineered based cost seg study regardless. There is what we call a limited scope study. We have done a lot of those. Sometimes those are if you are doing improvements, a limited scope study is not the best way to go because it's going to be you're not going to have the same detail you would have in a full study. So the limited scope studies is more of an abbreviated. It's to be competitive in the market with some of those other folks that aren't doing the site visits and those types of things. We will do like a virtual site visit, or we'll have you upload pictures and do that. We don't recommend them for anything over the say a basis of 500,000, just because they're not going to hold up in the event of an audit. It's one of those things that if you're doing improvement, it makes it very difficult, to have the partial asset disposition calculation because it's really just a calculation. So we always recommend doing the full studies, the full engineering studies, but there is a place for limited scope studies as well.
Okay. And you might have mentioned this, and I apologize if I missed it, but how far back can you go to do the study?
Yeah, really, there's no limit to how far back you can go. If you bought a property 20 years ago, you can go back to your cost seg. I don't know that you would want to, but you could. And so, my rule of thumb is usually about 15 years. If you can go back 15 years, and again, the IRS doesn't require us to do an amended return. We can just do a 3115 regardless of the age, as long as you still own it, you can do it. I do have a couple of clients that actually sold the property, still had access to it, went back and did a cost seg study on that property and used it going forward, which was beneficial. It was used kind of as that play, as I mentioned before, as a tax strategy and deferring the tax for another 18 months or whatnot. So that was very beneficial. So we see that very rarely because a lot of times when you sell a building, it's difficult to physically get back into it, right? But yeah, it's there's a lot of different ways to use it.
Okay. So I heard a rumor there might be some options for people like myself, or maybe some of our listeners who are real estate agents.
Options like what?
Something that Trump put into effect that benefits real estate agents?
Well, let's see here. Are you referring to the bonus depreciation?
I don't know. That rumor came from Ben.
You did not even bring that up. Just being a real estate professional, if you claim yourself as that, not an agent. And is there, related to bonus depreciation?
Yeah. So if you're a real estate professional, and those are very specific roles, you don't have to have a license, a real estate license. You just have to bank, 750 hours a year in real estate, managing your own property, and more so than anyone else. There's a lot of nuances with that. And so I think somebody just said they can't hear me very good. Are you hearing me okay?
I can hear you on my end.
Okay. All right. I just want to make sure the listeners are hearing me okay. But as far as the real estate professional, that it is a designation that you would file as a real estate professional. If that's something that real estate is your full-time job and that's what you do, then your investments are now ordinary income and not passive income. So and for the listeners on there, we have to think of that in two different ways, right? So if you have your tax return and you have active or ordinary activity over here, and then you have passive activity over here, right? Those two things, you have to remember that there's kind of a line down the middle, and you can't cross over, right? You can't have like your home deductions offset your passive income, right? Because that's all ordinary, and vice versa. You can't have your investment property in depreciation offset your W-2 wages, right? It doesn't work that way because of this line. When you become a real estate professional, that line disappears, and now your passive activity ends up being ordinary or active. So what happens when you're a real estate broker, or if you are a real estate professional and that's your main job, then the depreciation that you can take, the bonus depreciation. Let me just give you an example dollar-wise, because I'm a very kind of visual person. So if you buy $1 million property, let's just say it's net of land, it's $1 million, easy math, okay? So maybe it's 1.2 million, and then you got land. So you got $1 million in basis to deal with. And then let's say it's a residential property or whatnot. So you do a cost seg study, you take a tax deduction, the bonus depreciation would be somewhere in the neighborhood of about 300,000. Okay. So you take a loss of 300,000. Let's say you bought it in November, so you don't really have that much income because you didn't have it very long. So that 300,000 would sit on that books, and then it would roll over to next year. Or if you're a real estate professional, it will offset your W-2 income or offset your other income that you have booked from other properties if you group them together, for instance. So there's some things that you can do, could be very, very powerful if you're a real estate professional. You can use this bonus depreciation and you can bank it in this 1 year, and it can offset your income. And then next year you just buy more properties and it'll offset that income. So it kind of creates this chain reaction, which is very favorable to anyone who is a real estate professional.
Awesome, that's great. If anyone out there has any more questions, feel free to ask them now, Ben included, because I am out of questions. Here we go. How would a cost seg affect deferred recapture on a property that's part of a 1031 exchange?
Yeah. Okay. So the way it works, there's a couple. This is a really great topic, and I will preface this with I'm on the board of IPX 1031. So don't tell anyone I'm saying this because I could get fired. No. So there is a strategy out there with 1031 exchanges that is extremely valuable as well. But first of all, addressing the question, if you have excess basis, okay, let's say you buy a property for 500,000, you sell it for $1 million, okay, so you have a $500,000 gain, and now you buy a $2 million property. you have to take that $500,000 gain if you're doing a 1031 exchange, and you reduce your basis in that $2 million property. Okay, did I say two? Sorry. So let's say you bought a $2 million property. Now your basis is 1.5 million. Okay, so you lose some of your depreciation, but you can still do a cost study on the 1.5 million. Okay, whatever's left after the 1031 exchange. So that's how that impacts that. It won't be the full purchase price. It will be a reduced purchase price. But since we're on the topic of 1031 exchanges, it is important to note that there are a lot of people that do the 10. Well, let's say you're going to do a 1031 exchange and you don't meet the 45-day requirement, and so it falls out, and you missed your opportunity for a 1031 exchange. All is not lost. One cool strategy that we've been using is that you can sell a property, and as long as this happens in the same tax year, you buy another property. You basically are pocketing the gains from the first purchase, from the sale, and you can pocket those gains, and you buy another property in the same tax year. Then you can use those deductions after you do a cost study. You can use the bonus depreciation to offset the gain, so you don't really have to pay tax on it. So it's kind of a sense of doing the same thing as a 1031 exchange without doing a 1031 exchange. The benefits of doing it this way is that you're not kicking the can down the road. You just got square with the IRS using bonus depreciation. So you're essentially using their tax rules to pay your tax liability, and you don't have to kick the can down the road, right? So now you're square. You don't have to worry about increased tax rates, tax rates going up or anything like that. So it makes it really nice, and it's a really good alternative. Now, what won't work is if you sell a property on December 31st, obviously you won't have time to buy another one. However, if you purchased a property earlier in the year, you can use that bonus depreciation to offset the sale even after the fact. So you can kind of do it like a reverse 1031 exchange, and it still works, but it has to happen in that same tax year in order for that to be beneficial. Okay, so those are some little tricks that we use in the investment world. That in lieu of doing 1031 exchanges, you can use the bonus depreciation to offset that.
Okay, awesome. We do have some more questions that came in. Does the cost seg study need to be submitted with the return? I believe that's a yes.
No, the cost seg study does not. That would be a nightmare because our reports are like 150 pages when they're all said and done each. But you don't have to. You just have to have the cost seg study in your file in case you get audited. But when we finish a cost seg study, included in that, we provide your CPA the turnkey report. So we provide all of the tax depreciation schedules in that report. So they get to take those and plug those into their tax software, and that's what gets reported is how it was done. But if the IRS ever has any questions, ETS offers audit defense all the way up to the appeals court. So we don't charge for that. There's no cap for hours or anything like that. We do.
Okay.
Let me just ask, is that reported on the 3115? Is that only a one-time form, or do you file that every time? No,
it's a one-time form. The 3115 is just for the reconciliation. So if you have, if you bought a property, let's say you bought a property, like in Jason's case in 2020, and you've already filed your 2020 tax, obviously, right? So you already filed, and now you want to come back and do a cost seg study, then that form 3115 is just it's a method of accounting change, but it's essentially a reconciliation between here's what I should have taken, but I didn't because I was on a different methodology, and so now I'm going to make up for it. And it's just the one-time reconciliation from the account to file in the year that you want to bring that forward. So he would file a 3115 in his 2021 return, and that will prevent him from having to file an amended return. And he can go back and file an amended return if you have other things that you want to amend, but you don't have to.
Okay. And the other question we have, I mean, majority of our owners, at least in the last couple of years, have been buying houses, single family houses between 200 and maybe 275. I mean, that's kind of probably sold quite a few hundred of those. So I think the majority of the audience is going to be filing or asking for cost segs within that. So I see it, the price came up again. So Would that be a limited scope since they're similar? They're all going to be single family homes between that price, or should they still be getting the $2,500 full scoped ones on new construction?
Yeah, I mean, just a big, on average, a single family home is going to be somewhere about 3,100 for a full blown study. And
Okay.
it's really going to depend. I mean, if you're going to buy it and you're just going to hold it for a couple of years and turn around and sell it, maybe do a limited scope study without doing it. But if you're buying it, you're going to hang on to it for a while, and or you're going to do some improvements, I would suggest doing the full blown study. You know, the limited scope study is going to be somewhere about half that, you know, $15,000 to $2,000, somewhere like that. But a full study would be about $3,000, and usually you're going to get higher benefits from the full study, because when an engineer is there on the site, they're just going to get more information. They're going to have more, substantiation, and things are going to be a little bit more robust in that area. So, the difference, maybe the $1,000 or $1,500 difference that is, you may end up getting another 10% on the basis, and so it's clearly going to offset doing a full study on that kind of stuff. If you have 50 homes, that might be different, and it really depends on why you're doing the process. If you're doing it for the immediate tax benefit, okay, well, I can leave 10% of, on the table, let's just get these done. Or if you, like right now, we have to get them done fast. If I could probably have a limited scope study done in, a couple of weeks, I could probably still meet the deadline. But again, we might be leaving money on the table, and yeah, it might be a little bit cheaper, but we always want to try and do the full ones if possible.
The second part of that cost question says, and I know we talked about it, just real quick address it. Can you do a study now for rental properties we've held and rented for some years now? And the answer is yes.
Yes.
Another question. If you bank passive losses until your passive gains catch up with the losses in future years, is this a good tax strategy?
If your losses catch up with your gains, so you're basically paying tax now where you haven't before. I don't really understand it.
I'll ask it again. I don't know. If you bank passive losses until your passive gains catch up with the losses in future years, is this a good tax strategy? Might need some clarification on that.
No, I think I understand what they're getting at. I always do cost save. And let me tell you this. It's a little bit backwards than a lot of CPAs do. Okay, so like I hear CPAs all the time, like, don't do a cost save, you can't use it. You can't use the losses. You already have passive losses, right? But my CPA doesn't have any idea what my portfolio looks like. I mean, other than, they don't know what my plan is, my future plan usually, right? I mean, mine does, because I do like a tax planning session every 3 months because I'm very anal when it comes to that. Most people don't. But here's what I do, right? If I consider the bonus depreciation to be a gift, and it is a gift. It was a gift for a real estate president in 2017. We only have until 2026 for bonus depreciation. I find this a very valuable tool for building wealth and building wealth very quickly in the real estate area, if you do it right. If I have a purchase and it's going to sit on my passive side, I'm not going to sit back and go, gee, I don't need the losses, so I'm not going to do a passive study, because then it's like you're being an Indian giver. Here's your gift. Take the bonus depreciation. Oh, I don't really need that. Okay, well, you wouldn't give the gift back, would you? I mean, if you don't need it, you just find another way to do it. That's the way I look at bonus depreciation. So first of all, if it's a gift, I'm going to take it, especially if it has to do with tax. Number two, if I have too many passive losses, well, that just tells me that I have more options. Because let's bank all of those. And now next year, when those roll over to the following year, because if you don't use it, you don't lose it. You don't use it, it just rolls over the next year. So how does my CPA know that I'm not planning to sell one of my mobile home parks in 2 years, right? So maybe I really want to sit there and I'm going to bank my losses so that I can strategically plan to offset my gain when I sell, right? The other thing is, it kills me too sometimes, because they'll say, you can't use the passive losses. It's just going to bank up. It's like, oh, hell, you know what I'm going to do? I'm going to go find a way to put something in my passive losses so that I can have it free. Right? I mean, if I buy a house and then I turn around and I flip it, well, now I can use that against that because I'm just hiring a contractor to do all the work, right? So I just do my house and it's a passive income. And now I just put $100,000 in my pocket that I have to pay tax for because I have all these losses over here. So I strategically plan where my activity goes to match with my losses so that, but let's just say hypothetically, my CPA told me, oh, you can't use the losses, so don't file for a cost study when I bought a mobile home park 2 years ago, okay? Now I get an offer I can't refuse. And I'm going to sell that park, and damn, it's too late to go back and get my bonus depreciation. So I'm going to have to pay tax on it. And so if it's a gift, take it, and if you can't use it, find a way to use it, right? That's my theory.
That makes sense.
Like it.
Ben, do you have any other questions for Kim?
I think you did pretty good, Jay. Yeah, I talked to Kim last year and did really good for me. So highly recommend.
Awesome. Well,
Yeah,
Kim,
we'll leave you with one of my favorite quotes. And somebody had asked, can bonus depreciation only be taken in acquisition year or later? So, yeah, I mean, bonus depreciation, you have 2 years to go back and get it if you didn't take it. So you can do that. So just give me a call. I don't know if Jason is going to list all my 2 years from the acquisition date. No, it's 2 tax years. So if you bought it, say in 2019, you have until 2021 taxes file. So that's kind of the rule there. So no, not from the acquisition date, but from filing your tax filing. Yes. And then Jason, are you going to provide contact information or should I?
Yeah, we're going to send out the recorded version of the webinar to everyone, and I will gladly put your contact information in there. And
Okay, awesome. And then one other thing that I was going to leave you with is a quote that is my favorite, and that is, I believe everyone should pay tax. I'm an American, I do pay some tax, not a lot, but because I'm in real estate. But I believe everyone should pay tax, but there's nothing in the code that says you have to. So
awesome.
Let's take the tip off the table, and let's only pay what we have to pay.
Well, very cool. Thank you so much for your time. We very much appreciate it, and I'm sure everyone got something out of this. Very beneficial.
Yeah, no problem. Well, thanks for all your listeners for joining in, and thank you for having me, Jason and Ben. I really appreciate it. It's been a pleasure working with you both. If you have any questions, don't hesitate to reach out.
Very cool. Thank you, Kim.
Thanks, Kim.
All right, thank you. Okay, bye, everyone.
Bye-bye.